want to start off before we see any questions that do come in. I had an email today from Jim, and Jim is a new Power Options user, and he's getting what's called the PriceWatch Alerts morning updates from Power Options. Now, the morning update is something that you can opt into. If you go to the My Account tool, you can check your Priority 1 email subscriptions, and I can opt into the morning update. It will give you some recent market conditions, recent market discussions, as well as some of the top optimal covered call positions, tip sheet emails, and of course, end of the day portfolio. Let me just go ahead and update that now. Now, let's take a look. I'm going to go to the Learning Center very quickly, and we're going to go to the Priority 1 email archive. The PriceWatch Alerts, the morning updates that are sent to you in the morning, if you opt into it, are archived here. So we have 5/30/2025, May 29th, so on and so forth. So there's a big archive there. Let's go ahead and take a look at the archive for the PriceWatch Alerts and the morning update. Market sentiment tools currently is neutral. This is what you'll see in your email. And then it goes through the optimal covered call discussions based on our default criteria, looking at the monthly picks of the day that Ernie created, run after hours, of course, so the prices might change when you first log in. Well, we see this position here for ACM Research. Stock's roughly at $23 per share, and the optimal covered call is for the June 20th 19 strike at 425. And it's an in-the-money covered call. We're 4 points below, essentially, the stock price, but we're getting $4.25. The percent if assigned is 1.4% for 22 days of expiration, and the downside protection is 18.5%. Net debit, so if I bought the stock at $22.99, I did get $4.25 for that 19 straight call this morning. My total cost into the position would be $18.74, with a good probability of getting assigned at 19, making a 26-cent profit, or about 1.4%, as you can see, in the next 22 days. Now, Jim sent an email and said, I don't understand it. I'm looking at this position, and I'm seeing in-the-money covered calls. ACMR, Freeport McMurran, 3903, selling the 32.5 call, 1.2%. And Jim added that whenever I sell a covered call, I sell out of the money. I sell above the strike price. I don't see how I'm going to be able to profit by selling below the current stock price. Okay. So what this is based on is, if we go to the covered call menu, this is based on the monthly picks of the day. This is what Ernie tested. He tested monthly and weekly picks of the day for covered calls and naked puts. I did the preferred bull put credit spread screen. Ernie did long calls. And we've got some other picks of the day available as well. And it's based on rigorous testing. What I mean by rigorous testing, in our search tools, which is the same for any structure, any strategy, my apologies, you can screen for various options criteria: time frame, time value, implied volatility range, overvalued or undervalued, IV over HV, downside protection, percent return if assigned, important for the covered call, annualized returns, annualized downside protection, range in or out of the money, option premium, bid-ask spread, probability, delta, Black-Scholes ratio, again, overvalued, undervalued, volume, liquidity, put-call volume ratio, previous option volume, percent current option volume. If you're looking for those heat trades that are showing extended or very high option volume today compared to the last 90 days, that's all available to you. But at the same time, you can screen against various stock technicals, beta, 52-week range, average stock volume, broker recommendation, RSI, Bollinger Bands, simple moving average, MACD, historical trends, and more, and fundamentals. Well, for covered call, I got to buy the stock. So stock price range, obviously, earnings per share growth, PE ratio, PEG ratios, market cap. Do you want to look for small cap, mid cap, or large cap? Bankruptcy scores, Z-score, Springgate, and more. Avoiding stocks that have an earnings date between now and expiration, important with spread positions and premium generating positions. Ex-dividend date, not between now and expiration, between now and expiration. Or you could screen against our default lists, things such as, so you see a lot of the ones we've created on the webinars here for specific questions, but IBD list, leveraged ETFs, NASDAQ, S&P 500, Value Line, and others. So you can screen specifically against those programmed lists. Now, ran in the money searches, out of the money searches, at the money searches. Avoiding stocks that had earnings between now and expiration, not avoiding stocks between now and expiration, looking for higher implied volatility, looking for lower implied volatility. The criteria that's used here, shown over in the active filters, for monthly, of course, so we're looking at June. The weekly naturally is looking at the weeklies, but we're looking for specific criteria for overvalued calls that still offer a good downside protection and percent if assigned, going deep in the money for protection, stocks in an uptrend above their SMA 20, good broker recommendation, positive MACD cross, stock between 9 and 250, and avoiding earnings between now and expiration. And of the 50 or so iterations already tested over the tested time frame, these criteria performed best. Now, different markets, of course, we've got a screaming bull market in the NASDAQ. Yeah, I agree with Jim. I might want to be doing out-of-the-money covered calls. If I own those stocks, get some premium. If it goes up, I get that intrinsic gain, and I get the time value, and I'm looking at a very high percentage return. But why in-the-money covered calls? Let's just stick with that AMCR. Was it AMCR or ACMR? I think it was AMCR. Oh, sorry. ACMR. There we go, ACM research, 22.55, so a little bit off of the price we saw this morning. But what I explained to Jim is the mathematics behind the 3 or 4 important criteria of a covered call trade. And what we're talking about is downside protection. It's simply the option premium you receive divided by the stock price, meaning how far the stock can drop before I start losing money on the position. Now, I'll admit with Jim, the 19 strike at this point with the stock at 22.55, priced at 390, it's offering a 17.3% downside protection. So right away, if I entered that position today, if I got these prices, bought ACMR at 22.55, sold the 19 strike for 390, well, okay, so yeah, we're about $3.55 in the money. We get 390 at midpoint. We're looking at a 45-cent return on the position if we're assigned at 19, because my cost basis is going to drop down to essentially $18. Did I do that math right? It's going to drop down to, I'm sorry, it's going to drop down to about 1855. Sorry, my apologies. So we're going to be down about 1865, and so if we're assigned, we're going to make that 45 cents, which is a 1.9% return if assigned. The benefit of the option chain, if you're interested in covered calls, and I'm just looking at the call chain here, is on any stock, I can instantly compare what is my risk-reward ratio. In the covered call, we know that we have infinite downside, but we've never seen a stock, many stocks go bankrupt, of course. But in this case, I say, okay, here's what Power Options recommended. I've got a 17.3% downside protection with a 1.9% return with an 88% probability. Now, that's sort of the key that Jim was missing. The monthly picks of the day and weekly picks of the day, as well as what you're seeing on the PriceWatch Alerts, the morning updates, the optimal covered calls, we're not married to these stocks. We're not planning on holding them long term. This is designed to get assigned, get the return for your target goals in 10, 15, 20, 30 days, or less, potentially with the weeklies, and then move on to the new positions. So, I kind of see it. If I do my research now on ACM, I'm going to go up here. I'm going to look at the stock chart, company information, news and headlines. I'm going to see where the trend is, what's going on with the stock. But if I like this position, maybe I'm okay with the 21 strike. Okay, I'm getting 198. I've got about a 9% downside protection with the possibility of a 2% return in 21 days. Okay, not terrible at all. But I've got about a 68.7, 69% probability. With my credit spreads, as you guys know, you've heard me say, in the money covered calls, out of the money naked puts, I'd prefer to be in this range. Probably the 20 strike, 1.9% return as well with a 13% downside protection. If I get the midpoint price, want to be in that range. There's nothing wrong with this one. Now, there's nothing wrong with, say, the 26 strike either. If I wanted to hold ACM long term, get 33 cents, so I get a 1.4% yield right away. I'm getting 1.4%. Let's go to the 25. That makes more sense. I like this because we are at 1.9% unchanged and assigned here. So let's go to 2.1% here at the 25. We take in about 48 cents if we get midpoint, maybe 45. We're getting a 2% yield against the position for 21 days. Not bad at all. 24% annualized if unchanged. 37%, I'm sorry, annualized if unchanged. And if the stock moves up, we make 13.3%. But we only have a 24% probability of making that 13%. So it's a balance. And we've had these discussions before. I pointed Jim to our discussions on our covered call playlist. Why use in the money covered calls? We have a more recent one that I should update on our playlist as well. But why use in the money covered calls? Well, it comes down to your personal risk reward tolerance. If you have a stock, you've been tracking NVIDIA, you've been tracking Tesla, IBM even, McDonald's, it's something you want to hold long term. In the case of McDonald's or IBM, and you want to get the dividend, well, sure, you're going to be selling out of the money covered calls. You're going to be looking for a delta of maybe 0.3 or something along those lines with a low probability, 24 or 33% of being assigned. And you're just enhancing the dividend-like income because it's going to be a long-term holding in your portfolio. What we're showing you with the PriceWatch Alerts and the morning updates, and again, under cover called the monthly and weekly picks of the day, is a way to generate consistent income while having good downside protection in, let's be honest, uncertain market conditions with everything going on, both globally and here economically in the U.S. with the new administration. So the idea is I'm not looking for this as a long-term hold. I'm looking to get assigned, get the return, whether it's weekly, whether it's 2 weeks out, whether it's monthly, move on, and then open new positions the following cycle once that premium has been moved up as well. All right. So for Jim and for everyone else, that's the idea. Why would I trade in the money covered calls? Because it's a different approach. I'm looking to hit singles. Let's talk about it that way. I know it's a cliche that's out there in the market. It's been out there for years. But look, I'm looking to hit singles with close to an 80% probability. Make a good annualized return, but also have a good downside protection because I'm collecting intrinsic and time value. Selling out of the money, you're essentially flipping these returns, aren't you? Instead of a 1.9% return if assigned, 33% annualized return, and a 13% protection or downside protection, going out of the money, okay, I get 2.1% downside protection because I'm only collecting 48 cents, but I might make 13.3% return if assigned equal to the downside protection. I'm just flipping the risk reward and I'm flipping the probabilities. We're going from 24% probability of making 13% to almost an 80% probability of making 1.9% with 13% downside protection. All right, so that's just a little bit for Jim, but a little bit, again, revisiting that discussion of why use in the money covered calls. It comes down to your risk reward tolerance and your goals for the trade. This is a way to hit singles consistently, not be married to the stock, not looking for long-term growth on the stock. But if you have a long-term holding in your account, something you don't want to have assigned in your account for tax reasons you've had for years, have a much lower cost basis, then absolutely, you're probably going out of the money. But the option chain, if you're interested in a single stock, is a great way to compare those in the money versus out of the money. What is the downside protection versus percent if assigned? And of course, you can customize the columns to view all the annualized views, annualized if unchanged, annualized percent if assigned. I don't have that one added in there, but just using the change columns feature, you can add any of the features, any of the columns that we saw before.